The man in charge of the world's most valuable company reckons,
I think we're at the beginning of a new build-out, beginning of a new industrial revolution.
While the man in charge of the world's largest asset manager says,
that is capitalism. We're going to have some big winners and we're going to have some big losers.
So, will the AI boom end like the dot-com crash?
It feels like more of a tailwind than headwind, and we stay bullish.
That really rings alarm bells back to that NASDAQ bubble 25 years ago.
And how exposed are Kiwi investors? Welcome to the NBR Podcast. I'm your host, Simon Shepherd. Yes, the chatter is getting louder.
It's bringing back memories of the dot-com bust in 2001.
Is there going to be an AI bubble burst?
Yes.
If you've got a pension, if you've got savings, anywhere in the world, you will not be left standing if there is a reckoning in this market.
The problem with bubbles is it's hard to know if they're really what you think they are until it's too late.
Is the AI boom now a bubble ready to pop? So what's priming the speculation? It's the deals.
OpenAI and AMD announcing a 5-year AI data center deal.
OpenAI has signed a $300 billion deal with Oracle.
NVIDIA saying it's going to invest $100 billion in OpenAI.
The sums are incomprehensible, and it all seems like a money go-round. We have 2 points of view. Local analyst from Salt Funds, Matt Goodson, but first, a strategist from the world's largest asset manager, BlackRock.
Yeah, there seems to be something of a mega boom at the moment where there's a kind of dash, a scramble to be number one.
Ben Powell is the Asia-Pacific head of the BlackRock Investment Institute. BlackRock has $13 trillion of assets under management.
So the way it looks to us, at least, is if all of these various big AI companies are really concerned that if they're not first, they're going to be nowhere. So in that sense, if you like, Simon, spending a lot, maybe even spending too much is the right mistake to make, I think is kind of the frame, because spending too little is to kind of guarantee failure and anonymity in a world where maybe this is a critical kind of hinge moment. And if a company can win this race, the returns could be very huge. So it does feel at the moment like there is a real kind of scramble to be one of the, or maybe even the dominant player. And as you're saying, Simon, that's leading to some pretty exciting deal activity, which continues.
Is there a concern that all the deals are circular, though? I mean, it seems to be companies buying chips and investing in each other and setting up data centers, but it's among a certain group.
Yeah, look, $1 trillion here, $1 trillion there. Pretty soon we're talking about real money, Simon, right? So it is a kind of an astonishing heft of money that we're seeing. We are okay with it, I would say. So look, obviously at BlackRock, we're very thoughtful. I would stress we'd want to be very selective, right? So not all so-called AI companies are the same. So we would obviously be wanting to pick our spots. But let me take your question, directly. Actually, if you look at other industries, car parts comes to mind, right? So if you think about auto manufacturers, they have relationships with their suppliers, which look a bit like this. So what I'm saying here is setting up this kind of infrastructure, financial infrastructure, I mean, is not unprecedented, but what it is dependent on is, do we actually want the thing at the end? So the big question, I think, the financing is justified as long as there is a revenue stream at the end. So financing, we're okay, but again, very much dependent on what do we think about the future and the revenue that can be generated by the current kind of spending that we're seeing today.
Well, that's right. I mean, that is the question, isn't it? Will the companies be able to pay for it? Given at the moment, they are profitable, but not that profitable to justify these kind of $1 trillion figures.
So I think for us at BlackRock, we want to be very focused on when we are in the AI story. And if you'll allow me, Simon, I'll work back from the far future. So the far future, maybe 10 or 15 years out, societal transformation. So that's like a huge deal. I've got kids. My oldest is 10. So what labor market will Freddie, my 10-year-old, be graduating into, if all goes to plan, let's see, in 12 or 15 years? So I'm not dismissing that. That's like super important. But in all honesty, Simon, it's quite hard to say what what exactly that means for portfolios today. So let's, if you allow me, put that to one side. Stage 2 will be adoption, use case from governments, individuals, companies, kind of everyone. But what we think is currently still the story, when we are, is still stage 1, the build-out phase. So this for us is kind of a classic picks and shovels boom, where you sort of want to be along the recipients of the money who are at the moment able to charge not quite whatever they like, but some version of a lot, generating huge cash returns for them. And I just want to say that isn't just the chips, right? The chips is obviously central there, but it's the electricity you need, it's the copper wiring, it's the real estate, right? So there's, again, as BlackRock, the world's largest investor by far, we're kind of lucky enough to be able to be diversified in where we're looking. And I really want to stress, we need to be really thoughtful and careful, and it isn't just a thing called AI, right? We want to pick our spots, for example, in the CapEx recipients, and that, as I say, can mean real estate, which maybe isn't as obvious as the chips, but is definitely part of the AI super boom that we're currently seeing.
So the world's largest investment firm is okay with the circular deals and the incredible sums involved. For another opinion, we went local.
What we've seen is an evolution. It was customers buying capacity or building capacity. So think Microsoft, Amazon, Google et al.
Matt Goodson is Managing Director of New Zealand investment house Salt Funds.
Now we're seeing these much more circular deals of people putting capacity in place, chiefly centred around OpenAI and NVIDIA. And that really rings alarm bells back to that NASDAQ bubble 25 years ago, where we saw a lot of similar circularity start to occur towards the peak as customer revenues started to perhaps not grow at the extent they had been.
Right, so that's the key point you just made there. I mean, will there be enough? I mean, OpenAI is putting out predictions that's going to hit 100 billion within just a few years in terms of revenue. But is there concern that there is just not going to be the revenue to support these kinds of deals?
Yeah, I think in the last few weeks we've really started to see those concerns rise. Now, they may be right, they may be wrong. We'll know in a few years' time.
Yeah.
But I certainly think there's the risk of that sort of thing starting to occur.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets.
Is what's happening now echoing the dot-com boom and bust of 2000? Ben Powell from BlackRock says there is a key difference.
We try and stay close to the money, right? So the reality is these companies are making more money than any company in human history, right? That's the reality. So we can have a reasonable debate about valuation, and obviously we do that internally. But I think it's super important for us to state the obvious, which is this is not just a kind of irrational South Sea bubble. There is obviously something there. These companies are making more money than Croesus. So there's that, and that's kind of very important. Then can you have a sensible conversation about whether they should trade on 20 times PE or 27? Of course you can, and we do that all day, every day. But I just want to really stress, right, these are real companies making astonishing amounts of money. And for now, and the reason we at BlackRock stay bullish US equities is they continue to positively surprise, right? They continue to make more money every quarter than we thought was possible just 3 or 6 months ago. And while that continues, the momentum continues to be, we think, with us, so we stay long US equities.
Is that justified?
It is and it isn't.
Here's Matt Goodson.
You think back to the dot-com era, you had deals where Global Crossing and Quest would do 20-year capacity swaps. They'd each book the revenue up front and then amortise the cost over 20 years. So magic, you created profit out of thin air.
Okay.
So ultimately it was, the toys.coms and all of those guys, when they went bust, it ultimately fed through to the much bigger players. But it was the bigger players managed to get themselves into a power of strife as well. And you just sort of see eerie similarities to today when NVIDIA invests in a neo-cloud provider. Then the neo-cloud provider uses that investment to buy GPUs off NVIDIA.
Yeah.
Now, NVIDIA obviously books the profit from selling the chips.
Yep.
And the neo-cloud provider amortises those chips over a period of years, often too long a period too, by the way.
Right.
So you've actually generated profit, if you like, out of thin air. But what really matters is that neo-cloud provider, who's really a rental provider of computing power, are they getting the end customers? And that's where it's murky.
Yep. Okay.
And that's where the questions arise. So not too sure of the answers yet, but there's certainly a lot of questions increasingly being asked.
Let's just pause the AI deals to remind you that if you enjoy the NBR podcast, Independent Business Journalism, please give us a follow and share the love. Now, it's back to the future. It's not just the deals, it's the way AI is becoming the only game in town in the US economy. Here's a few eyebrow-raising stats. 80% of recent US stock market gains are all due to AI-related companies. The top 10 companies of the S&P's 500 companies are worth more than 30% of the whole index. And recent US GDP growth has come from AI. Here's BlackRock's Ben Powell.
So they're the engine room for index performance. And look, let's just fess up here a little bit, Simon. That's super uncomfortable. Right. So as every strategist would have said on your podcast over the years, you want to be diversified.
Yeah.
And yet you buy a so-called diversified index, 500 stocks. And the reality is you're super geared into just a few of them, right? Which is nervous, right? Makes us nervous. So I just want to be, open about that. But you're right. They are a dominant driver of US. And bearing in mind, in round numbers, US is about 3/4 of global equities, right? So these are dominant sort of globally, not just within the US context. And to your first part of your question, you're right. They're increasingly relevant at the GDP level, where the CapEx boom is becoming relevant actually at the macro statistic level. That's significant. So yes, I think it's appropriate for us to be having this conversation. AI is something we're all going to need to get our heads around, whether you're a user, whether you're a kind of citizen, whether you're running a company or anything else, right? It's real, and it's not next year or the year after. It is right now, and the implications for the economy, for markets, for your company, for how you run your own kind of our own little existences, I think it is like T plus now.
Right. In terms of exposure, I mean, you're just talking about how, it's such a dominant player in terms of the US economy and probably, the world index in terms of equities. I mean, there's a lot of, mums and dads and pension funds and exchange-traded funds, all of them who are exposed. Is there a risk that they are too exposed?
I would always stress the risk of not being exposed. So I think, 2025 actually, Simon, has been a kind of a good, if that's the right word, a good reminder. So back Liberation Day, it seems scary. And then obviously the market's ripped 30 or 35% since then. So again, sorry to sound like a strategist, Simon, but what I'm going to say is try and stay in the market. Of course, be diversified. Don't get too over your skis. Don't get too leveraged. All of that stuff. Like there's a reason that's, almost cliched, because I think it's true. So we would stress that, I guess, what you'd expect to hear from BlackRock, a well-diversified portfolio aligned with your goals, whatever they might be. Try and stay close to that, even when things feel good or when they feel scary. Try and stick close to your knitting, I think, is something like the secret of success over, let's say, a medium-term time horizon.
One concern is almost everyone is investing in the same stocks through their Kiwisaver, their exchange-traded funds, or even directly. They are known as the Magnificent Seven and include the usual suspects like Nvidia, Microsoft, Google, Meta, and Apple. So this concentration in the US sort of economy by these companies, and they're responsible for the GDP growth over there at the moment, does that make it fragile?
Absolutely. I saw some stats yesterday. The top 10 stocks in the US, so just outside the Magnificent Seven, their enterprise value is currently 78% of GDP. Now, that's you're measuring a stock, which is enterprise value versus a flow GDP, but it's still a common measure.
Yeah.
At the peak of the NASDAQ bubble, the top 10 companies were 28%.
So we're talking 78% of GDP now
versus 28% back at the peak in early 2000. Now, there's two things going on there. One is obviously AI, and that's by far the largest thing. But the second thing is also passive investing was in its infancy back then. And so you've seen a lot of investor, by definition, the more something goes up, the more investors buy of it. So you get this reinforcement of the trend.
Well, that leads us on to our next topic, doesn't it? So how would you describe, if you can, the exposure of, say, Kiwi investors or Kiwisaver investors to what's going on?
Well, if they have a if they are market weight global equities and their global equities funds are market weight, that's the exposure they have. It's 2V's very largest stocks.
Matt Goodson says one thing has caught his eye. Big differences in how fund managers with great track records are performing. Some are doing very well. Some are way behind. And that, says Matt, is because those ones have pulled their money away from AI. This points to this idea of FOMO, though, doesn't it? I mean, how do you know when to get out?
Well, you don't until afterwards. That's
right.
That's the problem. There's always lots of little warning signs, and that's I think what's really piqued my interest with these circular deals that have really become a trend in the last several months. That's certainly a warning sign. Other warning signs, ASML is a key provider of lithography gear to NVIDIA.
Hard, So when we say lithography gear, that's the gear that makes the chips.
Exactly, and their orders don't look particularly strong. So
Do they not?
No, so that's perhaps a sign that we might be starting to get a little bit close to a top.
Right.
But the market can keep on partying for quite a while, so it's very, very hard to tell.
What's your strategy?
Look, we've actually been investors in this space for quite a long time, going back years to when cloud growth was the major driver. So at one point we were substantial shareholders of a property trust that held over NXDC properties at the time in Australia.
Okay.
And has since merged into it, and then have a couple of other companies that have benefited, but we're out of that now. We're been very cautious in the space. We've been long-term supporters of Infratil, but have been, certainly not to the same degree that we were several years ago. And so, look, we're just trying to position the fund to not be left behind while this is happening.
Yes,
but be ready. Be cautious, be cynical, and recognise it for what it was. If you do get to that point where something happens. But by the same token, that could be years away, or maybe, just maybe, people do find the applications to use all this wonderful infrastructure that's been put in place.
That's the key question, is it? Will there be enough uptake to justify all this build?
Yep, and that's a very tough one to answer. Very tough one to answer. And look, for people who profited off the railways being built in the 1800s, most of the railway went bust. It was the people who had goods to transport.
Right.
And it opened up vast new markets.
Yep,
it wasn't the builders of the railroads.
Right.
And you sort of almost feel that it could, history may certainly rhyme, if not repeat.
One final .com analogy, the bust was bad, but from the ashes rose the modern-day internet winners. And BlackRock's Ben Powell is certainly bullish about AI. Digital disruption, including AI, is one of the 5 megatrends that BlackRock Institute of Investment Institute has identified to keep an eye on. Can you see anything derailing that megatrend?
No, I don't think so. I mean, we can debate the exact implications. So, crypto, stable coins, but I think the digitalization of everything is happening. And not to turn this into a different podcast, but you're going to see that physically insubstantiated when, robots, more and more, there's already robots, but when they come down the track. Right. So I think the digitalization of all parts of the economy is a mega force, which is very hard to see being derailed. So I think the force will continue, but we need to be careful about exactly where we want to have investment exposure based on valuation and much more kind of sober stuff. But to answer your question, I think the AI mega force is here to stay, and actually I think is going to continue to shock people in terms of its relevance to all of our lives in kind of every dimension. To be honest, Simon, I think we ain't seen nothing yet. Wait for the next year or two. It's going to be sci-fi, sci-fact kind of blending into reality. More of that to come.
And that wraps up this episode of the NBR Podcast. Social links used are in the description, and thanks to senior content producer Joseph Hisayasu. For early access to new episodes, subscribe at nbr.co.nz. Up next, why are Americans giving up their passports? I'm Simon Shepherd. We'll catch you then.